What if I told you that some of the wealthiest people on the planet built their fortunes not through stocks, not through crypto, not through some complicated algorithm, but through something you can literally drive past on your way to work every single day? Real estate has created more millionaires than almost any other investment vehicle in history, and yet most people assume it's out of reach for them. Today, that changes. Here's what we're covering: how real estate actually builds wealth, the different strategies available to you as a beginner, the mistakes that kill most first-time investors before they even get started, and the exact steps you need to take to make your first move. Stay until the end, because the final point alone could save you thousands of dollars and years of frustration. Let's start with why real estate works so well as an investment. When you buy a property, you're not just buying a building. You're buying multiple streams of financial benefit happening simultaneously. First, there's cash flow. If you rent a property out and the rent exceeds your expenses, that difference goes directly into your pocket every single month. Second, there's appreciation. Over time, real estate tends to increase in value. Third, your tenants are essentially paying down your mortgage for you, building your equity while you barely lift a finger. And fourth, the tax advantages are genuinely remarkable. Depreciation deductions, mortgage interest write-offs, and strategies like the 1031 exchange allow investors to defer and reduce taxes in ways that most employees never experience. Now let's talk strategies, because real estate is not one size fits all. The most common entry point is buying a rental property. You purchase a home or small apartment building, find tenants, collect rent, and let time do the heavy lifting. It's straightforward, it's proven, and it works. But it does require capital upfront and active management unless you hire a property manager. Then there's house hacking. This is one of the most powerful strategies for beginners, and it's criminally underused. You buy a small multi-unit property, live in one unit, and rent out the others. Your tenants cover your mortgage, sometimes completely, and you're essentially living for free while building equity. Many investors got their start exactly this way. Fix and flip is another popular approach. You buy a distressed property below market value, renovate it, and sell it for profit. This can generate significant returns quickly, but it also carries the most risk. Cost overruns, contractor delays, and market shifts can all eat into your margins fast. This strategy rewards experience and punishes impatience. Real estate investment trusts, or REITs, offer a way to invest in real estate without ever owning a physical property. You buy shares in a company that owns income-producing properties. It's passive, liquid, and accessible, even with small amounts of money. The trade-off is that you sacrifice direct control and some of the tax benefits. So you're interested. Where do you actually begin? Step 1 is getting financially ready. Understand your credit score, reduce your debt-to-income ratio, and start building reserves. Most lenders want to see at least 20% down for investment properties, though house hacking often allows you to use low down payment loans. Step 2 is education. Read books, listen to podcasts, watch videos like this one, and absorb as much as you can before spending a dollar. The knowledge you build now directly reduces your risk later. Step 3 is defining your market. Real estate is intensely local. A strategy that works in one city might be a disaster in another. Study the job growth, population trends, rental demand, and property values in areas you're considering. The best investors know their markets intimately. Step 4 is building your team. No successful investor operates alone. You need a knowledgeable real estate agent, a reliable lender, a good inspector, and eventually a property manager and attorney. Start building these relationships before you need them. Step 5 is analyzing deals ruthlessly. Run the numbers on every property you consider. Calculate your potential cash flow, your cap rate, your cash-on-cash return. If a deal doesn't pencil out on paper, walk away. Emotion has no place in investment decisions. Here's the mindset shift that separates successful investors from everyone else. They don't wait for perfect conditions. Interest rates are high right now, the market feels uncertain, and it can be tempting to sit on the sidelines indefinitely. But the investors who win are the ones who learn to find good deals within the current environment, not the hypothetical perfect environment that may never arrive. Real estate rewards those who start, learn as they go, and stay consistent. Your first deal will probably not be your best deal, but it will teach you more than any book ever could. The wealth you've been watching others build from the sidelines is absolutely within your reach. The only question left is whether you're finally ready to reach for it.